Hello, good morning everyone. My name is Shinta Amalina and now we are going to the third chapter with the title Financial Statement and Ratio Analysis. The section goal is student will understand basic analytical tools, use financial statement to determine cash flow and time value of money. And the module goal is student will understand the usage of financial ratios, making cash planning process and role of time value in finance. So, we are going to discuss about financial statement analysis. Financial statement is prepared to fulfill the company's purpose in making decisions through analyzing each statement in order to understand the healthiness of the organizations. The financial data is recorded in the financial statement, and once it is analyzed, it will provide valuable information for the managers, investors, shareholders, and many other parties. So this will be going to provide many information about the company, and we can compare between one company to another company, as well as we can know the performance of one company from each year. So there are four key of financial statements. Those are income statement, balance sheet, statement of stockholders' equity, and the fourth one is the statement of cash flow. There are five general categories of financial ratios. The first is liquidity ratios, activity ratios, debt ratios, profitability ratios, and the last but not least is the market ratios. Liquidity ratios is talking about the liquidity of the company. It is the ability of the firms to pay the solvency in terms of their short-term obligations. It is their ability to provide day-to-day cash. So it will once the ability of the firms to pay the bills may save them from the bankruptcy as well as financial distress. So there are several indicators for the liquidity ratios. The first one is the current ratio. The most common liquidity ratios by dividing the current asset over current liabilities. It is the most common liquid ratio, and how to get the current ratio is current asset over current liabilities. If we know the CA for $1,223,000 and the current liability is $620,000, so the current ratio will be $1,223 divided to $620, so we will get 1.97. The higher the current ratio is, the more the liquidity of the company. So after the current ratio, we can have the more liquid ratio again, which is we exclude the inventories, because inventories is the most illiquid ratio compared to the other current asset, because it is hard to convert inventory into cash. That's why how to get the quick ratio is by minusing the current asset minus inventory. After we get the results, we divide into the current liabilities. So let's say with the same amount of current asset and current liabilities with the previous one, so here we have the inventory for $289,000. So the quick ratio will be 1.51. And however, if the inventory is liquid, then current ratio is preferable. The next one is about the activity ratios. The ability of the firms to convert various accounts into sales or cash, or inflows or outflows that comes from the balance sheet's activity. So we can know how to generate the revenue and cash. So one of the indicator is the inventory turnover. It can measure how liquid or how's the activity from its inventory. How to get it? From the COGS, or cost of goods sold, divided to inventory. If we have the COGS for $2,088,000, so we can get with the same amount with the previous inventory, so we will get 7.2. Defining a good inventory turnover is by comparing with the same industry of other firms or the previous inventory turnover of the firms. The next one is the debt ratio. It is about the leverage ratio. Firms' position of debt refer to the money of other people that being used in generating profit. It means that they are contracted for long-term payments. One of the indicators is debt ratio. In how we measure it, it measures the creditors of firms or debt to financial assets. So how we get its total liabilities over total assets. So if we have the total liabilities for $1,643,000 and the total asset for $3,597,000, so the debt ratio will be 45.7%. It means that almost half of the assets is being financed by the debt. So it means they have high indebtedness. The company has high indebtedness. Well, the profitability ratios is how they measure the performance and the effectiveness of the company. One of the indicators is the return to total assets, also known as return on investment, and they can measure to generate the profit from its available assets. So how to get is earning available from common stockholders to total asset. So if we can have the number here, then we can get 6.1% for return on total assets. The results above indicates for each $1 from common stockholders investment could earn 6.1 cents. The last but not least is the market ratios. It indicates the market value of firms by measuring the price of current share to certain accounting values. The investor could understand the marketplace conditions in terms of risk and return based on this ratio. The indicator is price to earning ratio. It assesses the owner's appraisal of share value. And how to get this is that market price per share of common stock divided to earning per share, and we have the amount here for market price per share and the earning per share, so we can get 11.12. It indicates that for each $1 of earnings the investor pay for 11.12. So here is the quiz with the questions. If the company has total current asset for $1,004,000 and total current liabilities for $483, how much will be the current ratio? A. 3.88, B. 2.08, C. 1.98, and D. 2.58. So here is the end of the sections. Thank you for listening and watching. See you for the next sections.